From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, Treasury yields reading to stronger than expected U.S. data, and traders growing less confident in a December rate cut. And that's all as Donald Trump's potential policies create a host of economic unknowns. But we begin with the big issue, post-election uncertainty looming over markets.
So there's so many forces at the moment which are making it a little bit more uncertain of how far the Fed really needs to cut rates.
I think the Federal Reserve is still going to cut interest rates a bit further.
We will have a couple more cuts, and then it gets really hard to cut more.
Markets at this stage have only priced in 2 more rate cuts next year.
The reality is what they're doing is a mistake. Bond yields are up since they began cutting rates.
There's a lot of unknowns out there, and the unknowns are all around inflation.
What's getting a little bit messy is trying to figure out tariff impacts.
We are assuming that some of those tariffs will get pushed through. That will be inflationary.
What you're seeing between 2s and 10s, to me, is inflation expectations and inflation risk.
Whether or not many of these policies actually get implemented as stated is going to be incredibly important.
Let's take a look at WIRP. This is what it looks like on the Bloomberg terminal, and what it's showing you is pretty drastic changes in the expectations for rate cuts by the Federal Reserve. If you take a look earlier in the cycle here, just as early as December, you can see here that the market has expected now about a 62% chance of a Fed rate cut in December. However, that was about 50% just a couple of hours ago, and just a couple of days ago, it was an 80% chance. So the expectations not only changing drastically, but even if you go further out on the horizon, it really makes a difference in terms of how much the market actually thinks the Fed can cut over time. We're going to talk a lot about that on that show today. You flip up the board and take a look at the bond market volatility as well over the last 6 months, because the volatility you see kind of in the spot markets here really don't reflect what you're seeing in the futures market. After the U.S. election, you saw a real drop-off in bond market volatility as shown by the MOVE index, but you are still seeing some tremendous amount of movement when it comes to the 10-year in particular. Now, with traders now seeing the chances of another Fed rate cut this year as a coin toss, Boston Fed President Susan Collins reiterated a December cut is still on the table.
Inflation's coming back down to target. The labor markets are healthy. We're seeing solid growth. The goal of policy is really to sustain that healthy set of conditions, recognizing, there are risks on both sides. And so I think we're well positioned. I certainly wouldn't take another ease in December off the table. But again, we're not on a preset path.
Joining us now to break this all down, Leslie Falconio of UBS and Stephanie Larosiliere of Invesco. And Leslie, you take a look at the bond market pricing here, the fact that the market cannot decide. And this morning it was a coin toss, this idea of a December rate cut. Do you think the Fed can make it there?
We think they can. I mean, we actually think that they cut in December. And I think this week's CPI number actually gave them a little bit of fuel. I mean, after that, whether they go in December or not really isn't the issue. It's really the 2025 that we're paying attention to. And right now, the market, we believe, is a little bit too hawkish. It's only pricing in, as of this morning, maybe 2 cuts, maybe a little over, because, now it's really focused on tariffs, inflation expectations. So they've really taken out these cuts. And granted, growth has been stronger, right? We had, 2.8% in the third quarter. We have Atlanta Fed GDP now, while early, tracking about 2.5%. So we do think, growth is stronger, but the Fed has a long way to go to even get near towards their neutral, even versus our neutral, which is 3.5%. So we do think they go in December.
So, Stephanie, before I have you comment on 2025, I'm equally interested to hear what you think there. Do you think December can happen for a rate cut?
We actually agree with Leslie. We do believe that December is still in play. We do think that, the Fed has said that they're data dependent. I don't think any of that has changed. I think what has changed is, the U.S. presidential election and a lot of the various policies really has taken the focus away from monetary policy and what's actually driving that to things like the tariffs. And that's really taking the eye off of the ball. We really think that December's still in play.
Well, then, Stephanie, to the point of 2025, how much do you think that the Fed can cut next year, particularly with the tariff policy proposed by the president-elect?
Well, I mean, at this point, it's really difficult to talk about a policy that has yet to be written, right? So we've heard talking points of a policy, but at some point we're going to get more clarity. At this point in time, we're still calling for about 1% worth of cuts in 2025. We're thinking about 4 cuts, a quarter point each time. And we really think the Fed is going to keep that neutral rate right at about 3.5%. And, you know, I think right now the market is also talking about that rate being higher, and perhaps that is driving, you know, why we aren't seeing as many cuts priced into 2025 and the December cut now nearly off the table.
How do you take stock of the proposed policies, Leslie?
Well, I think to Stephanie's point, there's policies and there's implementation. And I think you have to take, you know, Trump seriously, but not necessarily literally. So we have to wait and see in terms of how these policies play out. But to her point, one of the reasons why that we have 4 cuts in 2025 or 100 basis points is because we believe that the Fed looks through the, you know, temporary inflation caused by tariffs, right? Fiscal stimulus is a different story, right? When you have that kind of growth and inflation from stimulus, it's much different than via tariff. So we think that they look through that and they continue to cut.
With all that said, you're looking at a 10-year now at 4.45, and there has been so much movement in the longer end of the curve. Stephanie, what do you do at the longer end? Do you buy at these levels?
We like Treasury yields right now. We like where they are. We think it's a good entry point. We're also, you know, right now loving what we're seeing in terms of fundamentals in the investment grade market. We think the fact that yields have gone up should be seen as a good entry point for those that are looking to establish a fixed income position, add to their fixed income position. We don't necessarily believe that, you know, where rates are right now, where they're going to stay. We do believe that this has a lot to do with the fact that the market is now, like you said, just moving away from the December cuts. I think a lot more bullish in terms of what the expectations are regarding what the tariffs will do to the overall economic environment, and really just downplaying, I think, you know, monetary policy and what the Fed can and has told us that they will do.
Leslie, what's the risk here that the 10-year gets meaningfully higher from here?
You know, that's one of the points. When you say, are we buying? Like, we're buying, but only up to the intermediate part of the curve. We don't like that back end part. Because I think partially because of the risk is that the fixed income market's forward-looking and it's very speculative. So the risk is that they cut, the market says you shouldn't be cutting because inflation expectations higher and yields actually move higher, right? Similar to what we saw in September. So part of that is risk to the market when we push towards that potential 5% that we saw in October 2023. So could we see that level in 25? Yes. Could it be sustained? No, it couldn't. And when we think about whether or not it goes above 5, you know, and it's sustained, given how tight credit spreads are, given how everyone sort of has the same play on in terms of I want that yield, I want that carry, if you start to move substantially higher, really that's the risk.
You know, it's interesting. We have to listen back to what Fed Chair Powell said just this week. He had given a hawkish tone on further rate cuts ahead, to your point.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
Stephanie, how do you see the push-pull between monetary policy and fiscal playing out as we start to see the beginning of a Trump turn next year, particularly when we have seen such tensions brew in the campaign?
Yeah, I think there's a lot of things that we're going to be paying attention to. I think, you know, the tax policy is one that, you know, we're going to be focused on. You know, based on what we've heard from the administration so far, it seems that, you know, maybe tax advantage products may take a hit. We may not necessarily see those in high demand. We talk about tariffs and we talk about the fact that, you know, that may actually, I think, you know, on its head may actually look like we might see a weaker dollar, but we in fact think that it may result in a stronger dollar. So that may also upend some of what we've been seeing here recently. And then when we think about, you know, the immigration side of things, right? You know, the U.S. has seen declining growth rates, and, you know, a big change to immigration is also something that we'll have to pay attention to, and all of the industries that are very much reliant on the migrant population for, you know, their day-to-days.
So immigration, trade, taxes. Leslie, when you take kind of the mass amount of change that you might get next year, what's impacting the long and the most, do you think?
In terms of the longest will be the fiscal side. In terms of, you know, obviously they're all going to have an impact. You know, tariff, immigration, they're all going to have an impact, obviously, on inflation expectations. Obviously, immigration is also going to have an impact on the labor market. But really what happens on the fiscal side, I think, is going to have the longer impact in terms of how this plays out. You're going to have, dueling forces for a while, with tariffs being inflationary but pulling down growth, but any fiscal stimulus, pulling up growth. So I think that's really going to be the difference. But it also really depends on how much they can actually get done. And that's really what's unknown. And also the duration of what they get. And so that's going to be, what we look at going forward. And unfortunately, there's going to be a lot of speculation. I know you showed the MOVE index, which has come down, right? But that was elevated for a very long time. And now that it's come down because we have certain unknowns known, there's still a lot of unknown ahead. So we expect the market to be choppy. We think the market's going to be volatile for the next several months.
Absolutely fascinating. The idea that we can get more volatility, especially as we watch Congress really start to soak in some of these new policies. Leslie Falconio of UBS and Stephanie Larosiliere of Invesco, we thank you both. Now, later today on Bloomberg Television, an interview with Chicago Fed President Austin Goolsbee. Don't miss that. It's at 2 p.m. Eastern Time. And next on Real Yield, we're going to dig into the credit markets and how it's reacting to the state of higher yields. This is Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where global issuance picked up this week. We're going to start in Europe, where spreads on euro-denominated high-grade bonds eased to the tightest since January 2022. That low borrowing cost helped to fuel deals, with Wednesday having the most number of issues in one day since September. And a similar story for U.S. high-grade, with companies taking advantage of robust demand and favorable borrowing costs. HSBC, Citi, and Goldman helped to drive the total weekly sales easily past forecasts. Tuesday through Thursday marked the largest three-day volume total since right after Labor Day. And in high yield, there was also that post-election rush, with notable names like Icon Enterprises and Molina Healthcare all selling debt, and it all comes with the junk bond spreads near the tightest levels since 2007. And speaking of spreads, Oksana Aronov from JP Morgan Asset Management says a more measured outlook might be needed going forward.
The last time we saw spreads at these levels were just before the GFC and just before kind of the bubble burst in the late 90s, early 2000s. Not to say that we're headed there, but to say that, look, these valuations are definitely pushing against historic.
Joining us now, Meghan Robson of BNP Paribas, head of U.S. credit strategy, and Dominique Toublan, head of U.S. credit strategy at Barclays. The issuance has been quite stunning from what you've seen in the market, especially given that we have not seen as many rate cuts as expected. What is in the pipeline now?
Great question, Sonali. So I think a huge driver of the issuance we saw this week was the low level of spread. So a lot of spread-sensitive funders, the financials, for example, see spreads where they are, and they want to lock in that funding. So we did see a bit of a lag, and now we're seeing those spread funders really come to market. I think that will continue to happen. Probably less issuance from those more coupon-sensitive borrowers, given that yields are still a bit higher. In investment grade, we think most issuers have pre-funded their borrowing needs already ahead of the election.
It's incredible because you have investors just flying into the market despite where spreads have been. Dominic, why is that the case?
It's yield, right? Everybody's looking for yield. It's the best yield you've had in the last 15 years, right? Post-GFC, there was no yield. So many people who were avoiding the fixed income markets because it was not yieldy enough are now looking again. And so you have lots of inflows that have been very, very steady. And when we talk to investors, they expect more inflows in the next 3 to 6 months.
It's incredible because you do have a few people out there still drawing caution. Of course, the market is speaking for itself. Do you think that there are risks investors are ignoring to chase that yield right now, Meghan?
I think for now, we're actually still constructive on spreads at these levels. So we're basically sitting at our spread target for investment grade to the end of the year at 78 basis points. And I think what investors are rightly thinking is we've just passed this major risk event, the major risk event of the year, the U.S. election. We have results. Policy uncertainty is lower in one dimension, at least. And then I think corporates are thinking, wow, I might be under a very friendly operating backdrop next year. You saw that with U.S. Empire Manufacturing earlier, seeing that huge spike. Corporates assume that it could be a beneficial backdrop. And then I think the second point, November and December are very seasonally supportive for credit. So I think for now, the valuations are justified as we head into the end of the year.
It was kind of an interesting comment you made a little earlier about this idea that you've seen a lot of companies refinance already. So what does that mean in terms of how investors chase the future supply? If you're not getting a whole lot of it, do you just expect much more money to be flowing in and that driving spreads to be at even more narrow levels?
It's tricky because the gross number looks big, right? Like this week we got $50 billion of issuance in IG. People expected 27, 28. But it was 35 billion of coupons and maturities paid back to investors this week as well. So you only have 15 to absorb. So it's not super large. Same story next year. You have a lot of maturities, a lot of coupons, right? The yields have increased, coupons are larger. So net, you get to numbers that are actually net of coupons and net of maturities. Next year, that will be lower than this year. So you don't need a ton of demand to keep spreads where they are.
How much credit risk would you take on at this point?
So right now, same page as Meghan, we think that spreads are about right. We're going to go stay tight for the rest of the year, the seasonal, all this that we discussed. Now, spreads are mean reverting, right? So we are at the tight end of all the ranges. So if you want to bet why we are in 1 year and 2 years, it should be wider than we are here. The question is, how long can we stay tight? 04, 07, we stay tight for some time.
Well, what widens spreads out at this juncture?
I think for us, the main tail risk is a reacceleration of inflation. So if the Fed does have to slow down or even pause rate hikes and that Fed put is removed from the market, I think that could jostle credit spreads and we could see a widening. But for now, we have seen this massive easing in financial conditions. If you look at the Fed Senior Loan Officer Survey, for example, this week, the first reading in 8 quarters that's been neutral and not tightening of conditions. So I think we have some time before that tail risk really comes into play.
Well, to that note, do you think conditions get even looser from here?
So what we believe is that the Fed's going to cut once in December. So maybe, a close call, but that's what we think. And next year, only 2 cuts. So not so much of cutting going forward. But if you look globally, as Meghan was saying, a majority of central banks are cutting. That's easing financial conditions. At the same time, what does growth look like? Our economists globally think that growth is only slightly lower next year compared to this year. So usually companies are doing fine in that environment.
Would you agree that you would only see 3 cuts into the end of next year? And if that's the case, why are credit markets frankly holding up so well? You would expect to see more cracks with only that many cuts.
Well, our base case is we do get the 1 cut in December. We definitely think it's more of a close call, though, and in play. And next year, we've penciled in closer to 4 cuts for now. I think the risk is we do see fewer than that. I think for now, credit is pricing in very strong fundamentals. So as long as we get that dovish tendency and a continuation of cuts eventually, investors are going to focus on earnings. If you look at this past earnings season, our earnings growth has surprised positively. We've gotten investment grade plus 5% year over year earnings growth compared to 1% expected. So the fundamental picture is what people will focus on. It's been a very positive one.
How much are you both seeing companies start to take on additional debt to fund buybacks? At that juncture, are investors happy with it? Do they like to see companies paying more in interest costs in order to pay the equity holders back?
There's a huge bifurcation. So you see some rise of animal spirits in the higher rated companies. Tech, obviously, lots of capex and all this has been going through. But if you go lower in ratings, companies are very careful. Take BBB minus companies year over year. They have delevered. They have kept capex flat. So they're not trying to push it here. And the paradox of the tariffs, in the sense that there's an unknown going forward, it's not clear that companies want to push. If you look at the pipeline of M&A, it's actually lighter now than it was a year ago. So we'll have to wait a little bit to see the coast being clear, and then maybe companies push. But so far, we're not seeing that.
How much are investors really waiting for that M&A boom to, but you were just starting to talk about leverage finance?
Yes.
Is that something that people are keeping their powder dry for?
I think there is an expectation that we will have an opportunity investors will have an opportunity to participate in M&A deals. We do expect a decent pickup next year for M&A. Not only have borrowing costs come down, equity multiples in certain industries look attractive from a high yield perspective. So I think that is something and will be a big opportunity next year for high yield investors.
Now, 30 seconds each. Favorite trade at this moment?
compression. If you look down the ratings, actually valuations are attractive compared to the rest. It's all relative, obviously. And if you think about lots of the policies that we discussed with central banks easing further what Trump policies are supposed to be, that's going to help these companies.
How about you, Meghan?
I would pitch European investment grade over U.S. investment grade. If you look at the European market, you're getting about a 20 basis point pickup relative to the U.S. I think there is a consensus, a lot of bad news already priced into Europe with expectations that trade war risk may weigh on that region and also slower growth. And so I think going forward that you'll see some potential, even if we just have a carry environment, for European markets to outperform.
Maybe a little bit oversold at this point. Meghan, Robson of BNP Paribas and Dominique Toublan of Barclays. Thank you very much for your time. Now, still ahead, the final spread, the week ahead, all eyes on NVIDIA earnings and a host of retail results also in the pipeline. We're going to get a health of the consumer and a check on how they're faring in this market. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Monday, world leaders gather in Rio for the G20 annual summit. And Tuesday, U.S. housing starts, plus retail earnings from Walmart and Lowe's. Wednesday, NVIDIA earnings after the closing bell, and more retail earnings from Target and TJX. And Thursday, I sit down with Citadel founder Ken Griffin at the Economic Club of New York. Very much looking forward to that conversation and his take on politics. And Friday, more data, S&P Global PMIs, along with comments from ECB President Christine Lagarde. And for my final thought, let's take a look at this chart showing how fast the private debt market has grown in just the last 6 years, with the assets under management nearly doubling from $800 billion to $1.6 trillion. If you're Apollo, you think that addressable market is actually closer to $40 trillion. And if you're Ed Altman over at NYU Stern, you worry that this number is what is keeping spreads so compressed in the junk bond market. The whole idea here being that with more debt going to the private market, there's less issuance up next. But that does it for us today. From New York, same time, same place next week. This was Real Yield, and this was Bloomberg.